Whether you're walking barefoot in the snow, escaping for a walk on your lunch break, or trekking halfway across the world for a lush view, it feels good when we unplug and connect to our simpler side. If only our everyday nutrition were that simple. It's time to simplify your wellness routine with Kachava. Getting the nutrition we need from that graveyard of supplements in our cupboards is often overcomplicated. Just 2 scoops of Kachava's all-in-one nutrition shake, and you've got 25 grams of protein, 6 grams of fiber, greens, adaptogens, and so much more. Plus, it actually tastes delicious. No fillers, no nonsense. Just the good stuff your body craves. So instead of adding to your backstock of supplements that overpromise and underdeliver, keep it simple with just 2 scoops that have the highest quality ingredients. Simplify your nutrition at Kachava.com and use code NEWS. New customers get $20 off an order of 2 bags or more, now through January 31st. That's Kachava, Kachava.com, code NEWS.
Frequency Podcast Network. Stories that matter, podcasts that resonate.
Start of a new year brings with it hope for a reset. Whether you're talking about health, economics, politics, you can run down the list. Well, so far, 2026 on some levels seems eerily similar to 2025, at least when it comes to the daily headlines of what has the American president done now? Well, we've seen the activities in Venezuela, the talk about Greenland, the U.S. Department of Justice launching an investigation into the goings-on at the U.S. Federal Reserve, and coming up, how are the trade negotiations going to go this year to renegotiate the old free trade deal between the U.S., Canada, and Mexico? It's interesting to see that despite all of the headline risk in the first couple of weeks, well, Canadian stocks have hit record highs. Wall Street started the year up in 6 of 7 trading days for the Dow and the S&P, and gold and silver have surged. So how do you, as an investor, deal with all of that volatility? Welcome to In This Economy. My name is Mike Eppel. My guest on today's show to talk about how investors can best navigate things for 2026 is Andrew Pyle, Senior Investment Advisor, Senior Portfolio Manager at CIBC Wood Gundy. Hello there, Andrew. Happy New Year. I think I can say Happy New Year because this is the first time we've actually talked to each other for 2026.
You know what? Happy New Year works for me just perfectly, Mike.
It was quite the start. You know, we were 2 days into 2026, and the U.S. president decided to launch the maneuver on Venezuela, pluck Maduro and his wife out of the country with a focus on the energy trade. You know, we were thinking or hoping perhaps that 2026 would start the year maybe quietly. That didn't turn out that way. How are you as a money manager? How do you maneuver around this with your clients this early on? Because again, new year, reset, you start thinking about how to plan for a year, but it's already been thrown a couple of curveballs.
Yeah, I mean, when we came into 2026, we knew that we would deal with policy uncertainty. I don't think anyone out there is naive enough to think that year 2 under Trump was going to be quiet, that we wouldn't be talking about some policy instability. I don't think anyone was prepared for the volatility and policy decisions out of the gate. Having said that, if you look at the markets today, if you were to tell someone, look, someone just launched an attack on Venezuela, somebody is threatening the sovereignty of Greenland, someone is threatening the independence of the Fed, and we've got slowing economic growth, we've got slowing employment growth, and inflation is not going away. Very few people would have thought that that's the setup for a positive market open, but here we are, 8 or 9 days into 2026, and for the most part, it's green on the screen for the major indices.
With some of that, I had this theory that because the U.S. president is the way he is and how he and his advisors do things, a couple of days later, the subsequent analysis of it is, well, maybe it wasn't as extreme as we thought. Case in point, the Venezuela tactic, Trump bringing in the energy companies to rebuild Venezuela. And it seemed like at the end of the day, it was about oil. Oh, shocker. The questions and or DOJ potential indictment on Fed Chair Jay Powell. Trump's been going on about that for a while. There's questions about exactly how who knew what at the DOJ about this, and then 2 days later, everybody's kind of speaking out against it. So I guess the question is that kind of how you play this, where it's like, everybody has to kind of take a beat before you really see that hyper reaction to anything that the U.S. Might do.
Yeah, I think the markets are telling you that's exactly the way they're playing this, Mike. The fact that you got markets up now, the fact that you're hitting record highs despite all this. I mean, we recall the taco trade of last year. I mean, we had, in April, a situation where, most analysts, most economists thought this was going to be really bad for the economy and bad for the markets. And yet we came out of 2025 with double-digit gains, mainly because the worst-case threats coming out of Trump didn't materialize and markets learned to adapt. And on top of that, most of the bulls in this market, Mike, are still playing off the same script. And that script is, look, if you're going to cut taxes, if you're going to have a deregulatory bent to policy, at the end of the day, those are all good things for the market. And therefore, why would I be selling into this volatility of policy when it's probably not going to materialize? That's a really hard bet for me to take at this point, but that's the sheet that you're seeing a lot of equity players now keying in on.
Having said that, from a domestic standpoint, the U.S. economy, while it is growing, I mean, there are, the pushback from the households in the U.S. would be prices are still very, much elevated. We saw that this week in the U.S. Inflation data that the U.S. president has tried to dismiss, but at the same time, he's bringing out ideas that I think internally within the Trump administration, they're worried about cost and inflation when he's talking about, putting a 10% cap on credit card interest rates, for example, or again, the whole thing about, Jay Powell not cutting interest rates enough. That has, that's more to do with the fact the U.S. massive government debt load and trying to bring down borrowing costs for the consumers and homeowners who, the U.S. housing market stalled right now. So there's a lot of underlying tactics here that, again, on the surface may be one thing, but under the surface, maybe not.
Well, you've nailed it on the head there, Mike, because at the end of the day, the Achilles heel for the U.S. economy is the consumer, right? 70% of the U.S. economy is consumption. We can talk about, the boost to growth last year from AI spending, but that's still not the lion's share of what is happening in the economy. And everything you've mentioned are things that ultimately can cause the consumer to go into hibernation. And if that happens, you're not going to get 2 to 3% GDP growth in 2026. You're going to get flat or potentially negative or contractionary environment. So this is why you're seeing these, what I would call acts of desperation out of the White House to attack affordability in any way possible to ensure that the consumer stays engaged. Because, and again, this links back into the AI story as well. If you lose the consumer, if you lose demand, it's very hard to monetize the spending that's gone on in the AI world to the extent that you don't see further correction in stock valuation. So everything I would say in 2026 is riding on the consumer. And more importantly, we've got midterms, which means the consumer is going to play an even more critical role in how policy is shaped between now and November.
The first part of our conversation here has been dominated by what the U.S. president has done, and that was kind of a theme for overriding many things in 2025. Bringing it here at home for Canadians, the headlines have already been just pounding every day about what's going to happen next and the uncertainty that brings for Canadian households. I don't see that trend necessarily changing. Do you this year? Can we get over that where we actually focus more internally on Canadian policy, economics, where we get out of the slump that we saw for much of last year?
Yeah, I don't think we can, Mike. And I think a lot of that really comes down to the focus that's going to be on external trade, which, started last year, carries into 2026. And we're not alone. I mean, what Canada is currently doing right now in terms of trying to divert its trade exposures and to, have a more stable or predictable supply chain environment is something that a lot of other countries are doing too. And I really do not see that shifting in 2026. It doesn't mean that you're not going to have any focus on domestic policy, but external policy right now in geopolitics, I would say, is at the top of the agenda for most Western developed countries right now, and it's very similar to 2018. I mean, we've been talking about, well, we've had a great start to the year, and in fact, if you do the analysis going back 50 years, every time that we started the first 8 trading sessions of a year, with 2% plus gains in the S&P 500, typically the year ends off pretty good. There are some exceptions, and guess what? One of the exceptions is 2018, which was year number 2 of Trump's first term and also a midterm election year. We saw considerable volatility, obviously, on trade, the economy, and that was one of those exception years, Mike, where the market or the S&P 500 actually dropped over the entire year, even though we started off strong. I'm not saying that's going to be repeated this year, but I think we got to be mindful of that policy and uncertainty. It is very similar to 2018.
And we've got, the Kuzma or UMSCA or NAFTA, whatever you want to call it, the trade talks. Those have to start up again in the summer. Trump's already dismissing it, calling Canada, it's irrelevant. He doesn't care if they have a trade deal. Now, again, that could just be bluster going in, set your position that you're not interested, but at the end of the day, you still come to the table and you talk to get a trade deal done. And then you've got Prime Minister Mark Carney going to China, and that raises all sorts of potential questions from how does the U.S., do they say, why are you talking to China? I heard commentary just this week about one of the best things to happen to China on trade is actually Trump, because it's pushing normal U.S. trading partners toward China, which may not have happened in the past.
Yeah, we'll think back, Mike, to when we put 100% tariff on Chinese electric vehicles. And last year people say, that'll never get lifted because no one wants to really annoy Mr. Trump. I think what you're seeing now, at least in 2026, are countries that are saying, look, what's the worst that's going to happen to me? Because whenever we talk about the worst, it typically doesn't happen, but I've got to do something. And I think you're seeing countries now coming out of paralysis regarding Trump and now saying, look, let's get back to business. In the case of Canada, China, I think it should have been on the table, for quite a while that you've got to re-engage. How that shakes out, we don't know. But if it shakes out positively for Canada, I think it's something that you have to do. And I think you're seeing other countries do that as well. And it really is thanks to Trump. And in some cases, we can thank Trump because we've been talking about diversifying trade for 50 years. And nothing really has happened until now. So maybe at the end of the day, when all the dust settles, we turn around, we thank Mr. Trump for giving us a more diversified trade portfolio like we talk about with investments.
Well, you raise an interesting point there about diversification of trade, and a lot of the talk last year was about the provincial trade barriers coming down. Most recently, the big we've been hearing more pushback between the provinces. Doug Ford's dumping out Crown Royal, which is ostensibly made in Winnipeg, and then you've got the Saskatchewan and Alberta canola farmers. They'd like to see trade with China, but that would require, BYD and other Chinese EVs to be coming into Canada, and that's something that Doug Ford doesn't want. So, it's even when you think there's momentum and the possibility of something getting done, you see these internal pushbacks, and it's very frustrating.
It's frustrating, but you know what? I don't think anyone should have thought this was going to be an overnight deal. You don't go from a system that this country has had, which has been the wrong system in terms of our trade exposures. It's hard to go from that overnight and correct it. I think it's always going to be 2 steps forward, 1 step back. Hopefully we get that, and it's not 1 step forward, 2 steps back. I think eventually the provinces are going to come to grips with the fact that, Canada has to diversify trade outside to stabilize its situation. And that is also going to require the provinces to cooperate. And, if it means bringing some electric vehicles in from China, which, again, lower cost, not too bad quality, may not be the worst thing in the world for Canadian consumers, I think it's something that everyone's really going to have to come to the table on. So, yeah, there's going to be setbacks, and we're going to roll our eyes at decisions that some of the premiers make. But I think ultimately the stakes are way too high to simply just throw it all in and say, forget this lousy idea of, more trade between provinces. I think it's just going to be a reality that everyone's going to have to accept. Let's bring it back a little bit to your investment portfolio strategy for this year, Andrew. One of the hottest sectors of late, and actually for much of last year and into 2026, has been anything to do with precious metals. Gold, silver, just taken off, platinum,
zinc, copper, you name it. They've all been going through the roof. Are you into that momentum trade at all, or do you think it's, considering the fact gold went up 65% last year, it's at record, silver is north of $92 an ounce this morning, for goodness sakes. Is that just about momentum, or is that actually the market telling us something that there are things on the horizon that we need to be aware of?
Well, I think it's investors saying, look, we need a place to not necessarily hide, but we need a place to store wealth that we feel confident in is not going to break apart. Because we always talk about, safe haven strategies for the portfolio when we enter a year where we think there's going to be increased volatility. And this would be one of them. If we were to see a year where the markets, this is the head fake, in other words, markets start strong, but we get volatility, potentially maybe markets don't go up double digits. Where do we go? And we talk about places like, consumer staple stocks. We can talk about utility stocks, which I think also will do well this year. But gold's up there. And I think anyone that was holding gold over the course of 25 should probably be writing a personal thank you letter to Mr. Trump as well, because that policy uncertainty that we're dealing with globally right now, and geopolitical uncertainty, is going to, I think, continue to support gold through this year. Even though most times we would say this has gone too far too quickly, we'll probably see a pullback. We're not seeing that because I think we're seeing investors really looking for that safe haven. And gold, for now, seems to be at the top of everyone's list.
Having said that, I mean, it's a safe haven, and yet and all over the course of decades. First of all, gold, I remember reading books about gold at $10,000 an ounce. That was the prediction. It never materialized. It was stagnant for years. Only over the past less than 2 years' time has it really gained traction. It can turn south pretty quick, can't it?
It can do, right? And investors need to be, cognizant of that. And ironically, to our earlier point, Mike, if things do not materialize in as dire shape as we think possible, in other words, if we don't get the worst case scenarios in 2026, you could see potentially a reversal of flows out of gold, because investors will then say, well, the worst is over, or I'm not as uncertain about the near-term future for the economy or markets, and therefore I don't need this stability. So I think it's an important point, Mike, that gold could pull back, but I think I would argue that provided we have the uncertainty that we're dealing with right now, and if, who would have thought that we'd be talking about someone talking about invading Greenland? In that world, I think everything is kind of on the table in terms of where gold can go. We've already got some of the big players talking about 5,000. It's hard to argue against those, but you do need to be cognizant of those drawdowns too.
And sometimes these things build on themselves from momentum, right? It's like the early trades in, but then you see a lot of money. That's the talk. The ETFs are seeing big inflows into the precious metals because it's like, oh, it's moving, got to get in before it, thinking it's just going to keep going higher.
Yeah, I mean, someone told me last year that Bitcoin was going to go to $1 million. And a lot of people may still believe that that's going to happen. And that will drive flows until something happens that causes a rethink of that forecast. And something similar could happen to gold, Mike. You're absolutely right. But I think we're starting the year off with no shortage of volatility in what is happening around the world. So you're going to, I think, still see that momentum trade for the near term.
At the end of this month, we've got decisions on interest rates for the Bank of Canada and the U.S. Federal Reserve. Is that going to be less of a story for the markets in as much as no one right now is predicting that interest rates are going to move anytime soon?
Yeah, I think pretty slim chance that we're going to see a rate cut from either central bank. I think the inflation numbers are telling us a story right now, and that story is, as much as we made extremely good progress on inflation, 24 and 25, that progress has now been halted. And now we have to deal with the risks that we've got embedded inflation that's not really going anywhere right now. And if we start to see excessive stimulation coming from the policy front in the States or elsewhere, then that could, again, push inflation up. So, no, I don't think we're going to see rate cuts anytime soon. When we will see rate cuts, Mike, I think under two scenarios. One, the economies of North America really do slow down more than what economists are expecting today. Or B, Mr. Trump ultimately gets his way with stacking the Fed and gets his 50 basis point rate cuts continuously. And then that gets rates down. But other than those two scenarios, I think we're probably stuck here for a little bit until central banks get a better feel for what this economic environment is going to look like in 2026.
Of course, if he manages to do that, that will lead to potentially some unintended consequences, which we will talk about in the future. Andrew Pyle, thank you very much for joining me today.
Thank you, Mike. My pleasure.
That was Andrew Pyle, Senior Investment Advisor, Senior Portfolio Manager at CIBC Wood Gundy. You've been listening to In This Economy. My name is Mike Eppel. Thanks for listening. We appreciate any and all feedback. You can get in touch with me on my email address. It's mike.eppel@rci.rogers.com. On social, I'm at Eppman. That's EPPMAN. We'll talk again soon.